said. I want to start with Bridget Foreman. Bridget's a CPA and a partner at Bartlett, Pringle Wolf, LLP in Santa Barbara, California. She currently serves as the partner in charge of the tax department, integrating seasoned tax expertise for closely held businesses, high net worth individuals, and real estate owners. A significant part of Bridget's practice focuses on partnership taxation, real estate, and tiered entity structures. Bridget, liquidity is king right now. In the complicated and rapidly changing tax world, I've got a few questions about that. First, with the passage of the CARES Act on Friday, what actions can we now take to create liquidity for our businesses through tax relief?
So the CARES Act was pretty exciting for us. There's a lot in there. It's approximately 850 pages. So, I'll speak on a high level. I'm not going to get too deep into the details. But for the tax side, the desired end result is to create, lower taxable income to save taxpayers' dollars so they can use them towards furthering their businesses, and also possibly to create tax refunds on previously taxed income. So on the corporate side, the biggest provisions that we see are actually adjustments to what happened back in 2018 with the Taxpayers Cuts and Jobs Act, or the TCJA. So what the TCJA did is they limited lots of different deductions that were normally fully allowed to taxpayers and businesses. And the CARES Act ratcheted some of those back or completely reversed what the TCJA put in place. The two specific largest ones is that the TCJA expanded the reduction of the business interest deduction allowance. So what the TCJA said is that for certain businesses, business interest deductions could only be taken up to 30% of adjusted taxable income. So if you had a down year or if you were suffering losses, chances were that you had to go back and recalculate what your adjusted taxable income was. Some of your interest deductions would be disallowed and pushed forward, which then would reduce your loss, thereby increasing taxable income. What the CARES Act did is it relaxed that and said instead of 30%, we'll now allow 50% of adjusted taxable income. So you're going to get to be able to use more of those interest deductions. They even went a step further and they said in 2020, we don't expect corporate income to be as high as it was in 2019, given what we're facing today. So when you're calculating what that adjusted taxable income threshold is, the 50%, you can take an election on your 2020 return and use your 19 taxable income number. So again, you're going to be able to use more of those deductions than you would be otherwise. The other really big one that we were all excited about was actually a correction in a drafting error in the TCJA, and that's regarding qualified improvement property. So qualified improvement property are basically improvements to the interior of a commercial building. Under the TCJA, they made an error and they made all those improvements subject to 39-year depreciation, which was not what they originally intended, but that's what the law said. The CARES Act fixed that and said, no, qualified improvement property is actually 15-year property, which also means it's eligible for bonus and could have 100% expensing in the year placed in service. So that is huge. If you think of a business person that has franchised restaurants and they do a refresh of several of their locations, that's all qualified improvement property. And you can possibly take the entire deduction for what you expended in the year that you expended it, which is fantastic. CARES Act also added new things, like they expanded the allowance for charitable deductions for corporations, allowing 25% instead of 10% of income. They also created a refundable credit against payroll taxes for those businesses that were hit hardest. So there's lots of great things in there to reduce current taxable income, but I think the biggest thing that they did is they got rid of the limits under TCJR for using net operating losses. So as of 18, net operating losses could not be carried back, and they could only be carried forward at 80%. Under the CARES Act, you can now carry them back 5 years. So if you think of a corporate business person, right now they're in a 21% tax environment. You can take those 21% tax environment losses, you can carry them back to pre-2018 and hopefully get refunds or offset previously taxed income that was taxed at a 35% rate. So you're getting that rate arbitrage, which is great, and hopefully will create some refunds and put some dollars in pockets.
Well, that's super exciting. It's nice to hear some good news for restaurant owners in there too, given these times for sure. So what about primary provisions for liquidity for individual taxpayers? Is there anything different there?
There's a lot of the same and some different. So NOL rules also mirror on the individual side. So again, if you're in a situation where you're creating losses now, you can carry them back. And remember, individual tax rates also went down in 2018. So you're still going to get a rate difference and hopefully get to offset taxable income at a higher rate from prior years. The TCJA, one thing that it did to individuals is it limited the amount of business loss that can be used to offset other income on an individual return, limited it to $250,000 per taxpayer. That limit has been taken away for 19 and 20. So now if you do suffer business losses, you can use it, 100% of it, to offset other income. And again, if it produces a loss, you can carry it back. As Rich mentioned, they relaxed the penalty on taking early distributions from IRAs. So if you have a COVID reason that you need to take an early distribution from an IRA and you're not 59 and a half, that federal 10% penalty is waived. And if you pay it back within 3 years, it's not included in taxable income. If you don't pay it back, you can spread out that taxable income over 3 years so you don't hit an immediate hit. Couple other things, a waiver from minimum distributions, increase in ability to take charitable deductions, and then the final thing is those wonderful stimulus payments that are going to drop from the heavens. They are only going to certain taxpayers within certain income thresholds. It's $1,200 per taxpayer, $500 per qualifying child. And the beauty of that is that you don't have to do anything to get it. They're going to look at your last filed return, whether that be an 18 or a 19 return, to determine your eligibility. If you do have direct payments or refunds that are put directly into your bank account, they're going to use that bank account information. It's just going to magically pop into your bank accounts. And if you don't get it, but situations change and you do qualify in 2020, you get to take that tax credit on your tax return.
Well, that's awesome, Bridget. Thank you so much.